What if I told you that you don't have to choose between your 3% rate and your actual dream home? I know it sounds too good to be true, but I've helped dozens of families here in Tennessee do exactly this: keep their amazing rate and move to a better home that fits their life today. I'm Jonathan Wilson, and today I want to walk through a strategy. It's honestly just called turning your current home into a rental property. And when done right, it can actually improve your financial situation while letting you move forward with your life. Now, there are three key things that you need to know to make this work and some important timing challenges to consider. This isn't right for everyone, but if you've been feeling stuck because you don't want to give up that low interest rate, this might be exactly what you've been looking for. Here's how it works in simple terms. Instead of selling your current home, you rent it out and use that rental income to help you qualify for a new mortgage on your next home. You keep your 3% rate on the rental property and you get a new mortgage at today's rates for your new home. By the way, do you know how many real estate investors would kill to have a 3% rate on an investment property? The key is making sure the numbers work. Here in Davidson County in Tennessee, single-family rental homes are bringing strong rents. 3-bedroom homes typically rent from $2,200 to $3,500 per month, with the average rental bringing in over $2,800 a month. Even more affordable areas within Davidson County can see 2 to 3 bedroom homes renting for up to $2,500 a month. This means many homes in Tennessee can generate enough rental income to not just cover the mortgage, but to actually put money in your pocket each month. But before you get excited, let's talk about what it takes to make this work. First, let's be honest about the qualification requirements, because this strategy does require some financial strength. Number one, you need a down payment saved for your new home. Since you're not selling your current home, you'll need to have the down payment and closing costs saved. And that's 5% minimum with a conventional loan. Number two, your debt to income ratio has to work. Lenders will count both your new mortgage payment and your existing payment when calculating your debt to income ratios. But here's the good news. They'll actually count 75% of the expected rental income to wash away your existing payment. Number three, you will need a tenant in place before closing on your new home. This is the tricky part. Lenders want to see a signed lease agreement plus documentation of the tenant's deposit and first month's rent before they'll let you close on your new loan. Here's the cool thing. The lease start date must be on or before your first mortgage payment is due. So if you're closing in July on your new home, your first payment would be due on September 1st, and your lease for your tenant needs to start no later than September 1st. Now, this can create some logistical challenges with timing that you'll want to plan for. And this may not be a strategy for someone who's already stretched financially, but if you have solid income, good equity, and some savings, it can be incredibly powerful. Now, let me explain this 75% rule because it's important to making the numbers work. Let's say your current home would rent for $2,400 per month based on your signed lease agreement. The lender is only going to count $1,800 of that towards your existing monthly payment. That's 75% of the rental amount. Why only 75%? Well, because Fannie Mae and Freddie Mac, they account for vacancy periods. The reality that rental properties aren't always occupied. So when we're running the numbers, if your current mortgage payment is $1,600 per month and the rental income is $1,800 a month after the 75% rule, then that's enough to wash away your existing monthly payment, helping you qualify for the new home. Now, for a conventional loan, lenders would only be able to count the extra $200 a month in income if you already had 1 year of documented landlord experience as shown on your most recent tax return. But whether or not a lender can count it, that's still extra income that you will feel. This is why this strategy works best when your rental income significantly exceeds your current mortgage payment. Okay, let's walk through a real example with Tennessee numbers. Your current home has a mortgage payment of $2,100 a month, and that's principal, interest, taxes, and insurance. The expected rent is $2,400 per month in rental income after your expenses. But let's be conservative and say $2,200 after maintenance reserves, and that gives you $100 per month in positive cash flow. Plus, you're building equity in that rental property through appreciation and mortgage pay down. But here's what a lot of folks forget to consider. There are also costs to being a landlord. Property management, if you don't want to deal with tenants directly, maintenance and repairs. Property management typically runs 8 to 10% of the collected rent. So on a $2,400 rental, that may be $240 per month for property management. But even with that cost, you could still break even or have a small positive cash flow while someone else pays down your mortgage for you. Now let's talk honestly about what it means to become a landlord, because this is a big decision. Well, the pros are, someone else pays your mortgage, you build long-term wealth through real estate, you keep that amazing 3% rate, and in Tennessee's growing market, you benefit from property appreciation. Now the cons, you're responsible for repairs, dealing with tenant issues, potential vacancy periods, and the stress that can come with rental property ownership, such as 2 a.m. phone calls about a dripping water faucet. Here's the good news. You don't have to do this alone. Tennessee has excellent property management companies that can handle the day-to-day landlord responsibilities for you. Yes, it costs money, but it can be worth it for your peace of mind. Just think of property management as buying back your time and your sanity. Okay, so how do you know if this strategy is right for you? Well, you need to ask yourself these questions. Do you have enough income to qualify for both mortgages, or will you be able to deal with the logistical challenges of documenting the new rental income? Are you comfortable with the responsibilities of property ownership, even if managed by someone else? Does your current home make sense as a rental property in terms of location and condition? Can you handle the financial obligation if the property is vacant for a month or two or longer? This strategy works best for people who have outgrown their home but recognize the value of keeping that low interest rate and generating long-term wealth. Maybe you need more space for a growing family, want to live in a different school district, or just want an upgrade. The key is running the numbers honestly and making sure you're not stretching yourself too thin. Here in Tennessee, we have some real advantages for this strategy. Our rental market is strong with steady demand from people moving here for jobs and our favorable tax environment. Nashville, Knoxville, and Chattanooga have growing populations and solid rental demand. Plus, Tennessee is landlord friendly with reasonable tenant laws and good property management options if you want to hire professionals to handle the rental. The combination of strong rental demand and your low interest rate can create a powerful wealth building tool. If this strategy sounds interesting to you, the first step is to get the numbers analyzed properly. I've created a moving calculator. It takes into account your rental rates, your current mortgage, and helps you see if the numbers work. And you can find that calculator in the description below. It is completely free and will give you a realistic picture of whether this strategy makes sense for your specific situation. Remember, before rushing into anything, you'll want to understand your options so you can make the best decision for your family's future. And if you have questions about how this works or want to explore your specific situation, I'm always here to help. That's what I do. I help families navigate these big financial decisions without all the pressure or the sales tactics. Thanks for watching, and I'll see you in the next video where we talk about how to buy your dream home before you sell your current one, and then use the sale proceeds to dramatically lower your new mortgage payment after the home sells without a refinance. I'm Jonathan Wilson, and I believe everyone deserves to have a fantastic mortgage experience. Thanks for watching.